Good morning and welcome back. Part 2 of Real Estate Economics weekly webinar series, this week covering Phoenix, Arizona. The previous section we addressed a little bit of history on this market area and watched the transition from fairly stable market conditions into distress. Now we'll address the distressed inventory if we could. You can see the build in distressed inventory here really began to take place in 2008. We continued that through 2009 with very little let up in 2010. I think it's well recognized that there are more delinquencies at this point than there are distressed homes. Programs, moratoria, and a variety of other efforts have been made to slow this process down. Probably at this point the most helpful thing would be more jobs, but we can see over the forecast period we're going to gradually pick up fewer and fewer distressed homes. As market conditions begin to improve, people are much more likely to try to hold on to their home instead of letting it go. Any sign of economic improvement, we think people will take greater efforts to keep their home, and there'll be fewer strategic defaults taking place. At the end of 2012, you will no longer be able to get forgiveness on any loan that's been not paid in full. If you've completed a short sale, you could get a 1099 for income forgiveness beginning at the end of 2012. That forgiveness period expires. We would expect anyone considering a short sale to make that determination by the middle of 2012 and avoid that serious engagement with the IRS. You can see in this particular market area, this is current construction. The market disruption has done tremendous damage to the new home supply. Building permits for 2009 and 2010 are about equal to 1990-1991 levels. At present, the job base is roughly 40% larger than it was at that particular time. So we are clearly not creating enough units in this market, or most markets throughout the West, frankly, to even replace units that are considered substandard, transition to other use like small commercial, small office, that sort of thing, group quarters. So we're really going to be building some pent-up demand at the point in time that we see a little bit of job recovery. You can see here on the right-hand side of the chart that the supply will gradually come back, but it won't approach even 1996 or 1997 levels in the 5-year forecast. This is our unemployment forecast. Please note this is an annual number, so if the 2010 projected isn't exactly on top of today's monthly figure, that's why we're completely annualized here. If you can see, 2007, this market area only had 3.4% unemployment, one of the most vibrant and potent job creating areas in the nation. We've seen that go up by 2.5 times into the current annualized number of 8.8, still well below what's taking place on the national level. We believe this state has a number of friendly policies to employment, and that will help it perform better than the rest of the nation going forward. Many businesses who face challenges, labor-related challenges, are likely to consider this to be a good place to locate going forward, and we expect this market area to perform fairly well on the 5-year forecast. Still, over that time frame, we're not going to approach the historic lows in unemployment back in 06 and 07. You can see the change in jobs on this particular graph. This market tended to pick up 30 to 60,000 jobs a year with a little bit of low in the 2002 time period. That would sync up pretty well with the dot-com implosion. Then we had a tremendous rebound, creating more than 100,000 jobs. Again, one of the most vibrant job markets in the nation for 05, almost as many in 06 before this tremendous disruption took hold, and we've paid back roughly 220,000 jobs, a sizable chunk even on an employment base this size. In the forecast period, we start to pick up some jobs in 2011, a little bit better in 2012. Going out, there's some improvement every year, but not nearly sufficient numbers to erase the 220,000 losses we experienced between 2008 and 2010. It's likely that many of the jobs that disappeared in that time frame are not going to reemerge. Construction certainly, and a number of other job classifications are disappearing. The jobs that are lost are disproportionately higher paying, disproportionately affecting older workers over 50, and disproportionately affecting males. All these signs, at least at present, are symptomatic of a severe recession that has yet to run its course as of this point in time. Let's look briefly at fixed mortgage interest rates. The most notable series here is 2008. We had 6.0% annualized basis mortgage interest rate going down to 5.0 in 2009. That's the result of government intervention. That provides tremendous improvement in affordability for new homes and any sort of home that really draws much higher potential prices, assuming all economic conditions are okay. The household income will support much higher prices at 5% than it does at 6%. You can see over the forecast period we have a slow but steady climb. Right now that climb is being moderated by our friends in Greece and on the European continent, where their economic problems are driving a lot of demand for U.S. Government bonds and GSE paper, that sort of thing. Over time that's going to dissipate. We'll pick up some higher rates, which is going to help keep a lid on home price inflation over the 5-year forecast period. A big thing taking place in this particular market area is population growth. We have growth in a number of age categories, which means we'll probably have housing demand well distributed over all types of different product types. If anything, you're going to get an abundant mature market demand taking place in this area. People are going to examine high cost states like California, look for much lower cost states to live, and Arizona really fits this bill. People are over time going to consider the financial condition of the state they're moving to. So once the economy resumes and the state finances in Arizona start to clear themselves up a little bit, this will be a very appealing area to retire to. We would encourage all builders, whether you're building age qualified or all age product, to put some floor plans into your development that targets the mature buyer. They bring equity, they spend more money on options and upgrades, they buy premium lots, they qualify for loans, and they make larger down payments. So that's a perfect buyer profile for an unsteady economic time period. That's part 2 of our 4-part presentation today. In a few moments we'll begin part 3, Real Estate Economics Weekly Webinar Series covering Arizona.